Many sub-Saharan African countries are finding themselves caught on the horns of an economic dilemma. They need to tackle mountains of expensive debt, but to do so requires the unpopular move of slashing spending. So how did this come about? Well, sub-Saharan African economies have been hit by repeated shocks since 2020, including the global health crisis and conflict in Ukraine. At the same time, the continent's booming population and climate change mean the demand for public money is growing. Last week, the International Monetary Fund urged the region's policymakers to cut costly fuel subsidies and raise more in taxes. But higher taxes will hit populations that are often grappling with a cost of living crisis, and fuel subsidies are popular. Countries from Ghana, which defaulted on its debt last year, to Kenya, which needs to pay back or refinance a $2 billion international bond before next June, have seen violent protests against tax hikes and subsidy removals. However, the IMF is warning that there's more trouble ahead if economies stay on the current fiscal trajectory. In a recent report, it cautioned that the region's debt-to-GDP ratio, which has already doubled to 60% in the last decade, could rise a further 10 percentage points in the next 5 years. That's exacerbating what's already a tight squeeze on state coffers. Developing countries' interest payments have grown faster than public spending on health, education and investment over the last decade, a UN report said in July. Sub-Saharan Africa's ratio of debt interest payments to government revenues has more than doubled in the last decade to 10.5%. That's about 3 times the ratio of developed countries, according to the IMF. In many nations, it's much higher. Ratings agency Fitch forecasts, for example, that the ratio will hit 40% in Nigeria and 28% in Kenya next year. High interest rates make refinancing debt prohibitively expensive for most African countries and have weakened their currencies against the US dollar. The fear ultimately is the impact on services. The IMF's African Department Director, Abebi Selassie, said that what they're trying to avoid is spending on health and education being harmed. But he warned that's exactly what could happen if the current situation persists. Oxfam International has forecast that public spending could drop in real terms for the next 5 years in 26 sub-Saharan African countries. And that could be counterintuitive to tackling the economic conundrum. The anti-poverty NGO's Inequality Research Coordinator, Anthony Kamande, said that if you educate people, you increase productivity and human capital. But how are they going to do that, he asked, if the little that they have, they are just spending on debt servicing?